Welcome back to the deep dive. You guys sent in some really interesting stuff this time around.
Yeah, pretty diverse mix.
It's a lot. Financial news, market analysis, even some political stuff too. We've got excerpts from Apex Trader Funding, strategies and market analysis.
That's a good one.
Then there's a piece from Confronting Challenges to Mental Health in the Black Community.
Okay, interesting.
And last but not least, Market Domination, Investing Playbook, Economic Analysis, and Stock Trends. Seems like everyone's trying to figure out what's really happening, connect the dots.
Absolutely, yeah. Trying to get a grasp on all the moving pieces, especially in the markets.
It's a puzzle for sure. On the one hand, the market's hitting new highs. Everything seems great on the surface, right?
Yeah, you'd think so.
But then you've got all this talk of tariffs, possible government spending cuts coming down the pipeline, and inflation's still sticking around.
It's a lot to process for sure.
It's like everyone's celebrating while the house is slowly burning down around them. So how do we make sense of this? Where do we even begin to untangle this economic knot?
Well, one place to start is that drop in consumer confidence. One of the sources highlighted a 7-point drop.
7 points.
Yeah, from 105 to 98, and all in just a month. That's a pretty big swing. People are definitely feeling uneasy about what's coming next.
I mean, 7 points in a month, that's got to be significant, right? Have we seen swings like that before? What happened?
Historically, drops like that often happen right before a recession. Like, think back to 2008, just before the big financial crisis. Consumer confidence plummeted then, too.
Okay, so maybe not just a coincidence, but is it all about, people's feelings, or are there real economic factors driving this anxiety?
It's a bit of both, honestly. Sentiment plays a huge role in markets, but there are real economic pressures at play, like those potential government spending cuts. Remember the whole GDP equation? C plus I plus G plus NX.
Vaguely, yeah. It's been a while.
Oh. Consumption, investment, government spending, and net exports. It breaks down how a nation's economy produces output. So if you cut government spending, that G in the equation, it has this ripple effect. It hits consumption, the C, which is like the biggest chunk of the U.S. economy.
Right, so less government spending equals less money flowing around, and that makes people nervous, less likely to spend themselves, which just makes the whole thing worse.
Exactly. It's a downward spiral. And we're seeing proof of that fear in the markets. You mentioned bond yields dropping.
Yeah, that was in one of the sources, 8 to 10 basis points, I think it said.
You got it. Think of basis points like tiny fractions of a percentage point. So when bond yields fall, it basically means investors are getting nervous and putting their money into safer assets. It's a classic flight to safety, and historically it often signals a bigger economic downturn on the horizon.
So it's like the canary in the coal mine, but for the whole economy.
That's a good way to put it. And this unease is definitely spilling into the tech sector. Your source highlighted the Magnificent Seven, those big tech stocks, Apple, Microsoft, all those, and they're down 11% from their highs.
The Magnificent Seven, that's a catchy name. But 11%, that's a pretty big drop. Officially, I think that qualifies as a correction, right?
Yep, that's the technical term. And it's happening after such a huge run-up for tech. So the question is this just profit-taking, or is there something more fundamental going on?
Yeah, I mean, is the AI bubble about to burst? It seems like everyone's been pouring money into AI lately.
There are definitely some concerns about the sustainability of that AI boom. Your source mentioned a report from TD Cowen suggesting Microsoft might be slowing down its infrastructure spending.
So that's like the nuts and bolts of the AI world, right? The data centers and all that.
Exactly. If those investments slow down, it could raise doubts about future AI spending overall.
Okay, so definitely something to watch. But amidst all this uncertainty, some companies are still doing pretty well, right?
Right. There were a couple of examples in the source material. CP Rail, they're a Canadian railway company.
CP Rail, okay.
And Archie Capital, an insurance company. Both seem to be navigating this choppy economic water pretty well.
So like ships weathering the storm, what's their secret? How are they managing to stay afloat when others are struggling?
Well, CP Rail has a really strong balance sheet, and they've made some strategic acquisitions. They're really playing the long game, focusing on those fundamentals, and they're using this time to invest in growth and buy back their own stock, which tends to boost share prices.
Makes sense. Playing smart, thinking long term. What about Arch Capital, though? Insurance, it doesn't exactly scream high growth, especially with everything else going on.
True, but Arch Capital is known for being incredibly well-run, incredibly agile. They're constantly adapting, shifting their focus to where the best returns are. Right now, that includes reinsurance.
Reinsurance, I always get that confused. Isn't it just insurance for insurance companies?
You got it. They help spread the risk. especially during uncertain times like these. Arch Capital is a leader in that space, which is why they're so attractive to investors seeking stability.
Oh, I see. So they're not just weathering the storm, they're basically selling umbrellas to other ships. That's pretty clever.
Definitely a smart strategy. And it contrasts sharply with companies that are struggling, like Reddit. They miss their user growth targets, which is never a good sign for a social media platform.
And competition's fierce in that online world. And didn't one of the sources mention Deere, the farm equipment company? They're having a tough year too, right?
Yep, Deere's forecasting a challenging year for the agricultural sector. They're pointing to those steel and aluminum tariffs as a major factor.
Ah, those tariffs. That brings us to the elephant in the room. President Trump's plan to put tariffs on any country with higher duties on U.S. goods. The source material was a little vague on the details, wasn't it?
Yeah, which is part of the problem, right? It's creating a lot of anxiety because no one knows exactly what goods will be targeted, at what rates, or for how long.
It's the uncertainty that's so unsettling. Like, how do you even plan for that? The source mentioned auto insurance as one potential area of impact. If those tariffs hit imported car parts, repair costs could skyrocket, and we'll all end up paying higher insurance premiums.
It's true, that's one potential domino effect. But it's not all doom and gloom, right? The source mentioned a potential upside for beer drinkers.
Wait, seriously, good news for beer lovers. I'm listening.
Well, Constellation brands, they make Modelo, right?
Yeah.
They might be hesitant to raise prices, even if those tariffs push their costs up.
So you're saying my Modelo might actually get cheaper?
It's a possibility.
Yeah.
It could give them a competitive edge against rivals like Anheuser-Busch, who might be quicker to pass on those increased costs to consumers.
Interesting. So it's not just about the direct impact of the tariffs, it's about the strategic decisions companies make in response to them. I never thought about it that way.
And you have to look at everything. Like, the source also mentioned copper prices spiking after Trump's announcement. Turns out tariffs on copper imports would actually be good for companies like Freeport-McMoRan.
Why Freeport-McMoRan?
They're one of the world's biggest copper producers. If imported copper gets more expensive, their domestically produced copper becomes more competitive. They're actually benefiting from this whole thing.
So every policy decision creates winners and losers. It's a lot to keep track of.
Absolutely. And we're not done yet. Remember that report about the Trump administration considering merging all the bank regulations, potentially even folding the FDIC into other agencies?
Oh, yeah, that was in one of the sources. Seemed kind of risky, didn't it?
A lot of experts think so. They say consolidating the FDIC could weaken consumer protections and create systemic risks in the whole financial system.
So it's not just bureaucratic reshuffling. This could actually affect people's lives.
Definitely. Think about it. Higher bank fees,
Mm-hmm.
potentially more expensive transactions, maybe even a comeback of predatory lending. None of those sound good.
Yikes, no thanks. And the source mentioned the CFPB headquarters being temporarily closed by acting head Russell Vought.
The CFPB, that's the Consumer Financial Protection Bureau, it was created after the 2008 crisis, specifically to protect consumers from shady financial practices.
Right. So closing it, even for a bit, is sending a pretty strong signal, isn't it?
Definitely. And it raises some concerns about the direction things are heading when it comes to consumer protection.
Okay, so we've got potential trade wars brewing, talk of spending cuts that could trigger a recession, and now this possible deregulation of the financial industry. It's a lot to process.
It is. But that's why we're here, right? To break it all down, connect the dots, and make sense of it all.
I appreciate that. I'm already starting to feel a little overwhelmed, like we're heading into some uncharted economic waters. And that brings me to a question that's been bugging me. Could all of this lead to stagflation?
Stagflation. Now, there's a word we haven't heard in a while. And yeah, that's a scenario with some potentially serious consequences.
It is. Given the potential for tariff-driven inflation and a Fed that seems hesitant to step in, could we be facing a situation where prices are rising while the economy is slowing down? That's a worst-case scenario, right?
It's definitely a possibility and one we need to take seriously. And navigating that kind of environment requires a whole different approach to investing.
Okay, so if we're staring down the barrel of stagflation, what do we do?
Well, that's a question for part 2 of our deep dive.
Stay tuned, folks. Things are about to get really interesting. Okay, so we left off talking about stagflation, definitely not the most cheerful topic.
No, not exactly the most uplifting thing to think about.
But it's important to understand what we could be facing. So walk me through this. What exactly does stagflation look like? What makes it so tricky?
Well, imagine the economy just stuck in neutral. Slow growth, high unemployment, but prices are still climbing.
That's a rough combination.
It is. It's a double whammy that really challenges those traditional economic ideas.
Ouch. So a stagnant economy, but everything's getting more expensive. My wallet's already hurting. If prices keep rising but the economy's sputtering, doesn't that make stocks a bad investment?
It definitely throws a wrench into the usual playbook. Normally, during inflation, stocks can be a decent hedge, right? Because company earnings go up with prices.
Right, right.
But in a stagflation scenario, that slow growth can actually drag down those earnings. So you lose that benefit.
So what's the playbook for investing in that environment? Where do you even start?
You have to think a little differently. You need assets that can handle both inflation and slow growth.
Hmm.
Like one classic example is commodities.
Commodities, you mean like oil, gold, things like that?
Exactly. Commodities tend to do well when there's inflation because their prices go up along with everything else.
Hmm.
And some, like gold, are considered safe haven assets.
Safe haven.
Yeah, they hold their value pretty well during economic downturns. People flock to them when things are uncertain.
So commodities offer protection against both sides of the stagflation coin. Makes sense. Are there any other strategies that could help in this kind of scenario?
Another approach is to zero in on companies with strong pricing power.
Pricing power.
Basically, businesses that can raise prices without scaring away customers.
Ah, so they can pass on those rising costs without hurting demand. Got it.
Exactly.
Hmm.
Think about healthcare, for example. People need medical care no matter what the economy is doing, and those companies can often adjust prices accordingly.
Okay, healthcare is a defensive play. That makes sense. What else?
Consumer staples. Those are things people always need, like food, beverages, household products. Companies like, say, Procter& Gamble or Unilever, they usually have the pricing power to handle inflation.
So I should stock up on toilet paper and ramen noodles and buy stock in P&G.
Well, no need to hoard supplies,
Yeah.
but adding some exposure to consumer staples in your portfolio might be a good idea.
Okay, got it. Commodities, healthcare, consumer staples. Anything else to keep in mind if stagflation hits?
Absolutely. Don't underestimate managing your debt. Stagflation usually means higher interest rates, and that makes paying off existing debt more expensive.
Oh, good point. So better to tackle those high-interest debts now before rates potentially climb even higher.
Exactly. And if you're thinking about taking on new debt, be extra careful. Make sure you understand the risks in this kind of environment.
Okay, that's all super helpful. I'm feeling a little more prepared to tackle this potential stagflation beast. But before we go any further, let's circle back to that source about mental health in the Black community. It felt a little out of place at first, but I'm curious about the connection to our economic discussion.
Yeah, I was wondering about that too. It seemed like an outlier.
Right. But there's actually a fascinating link to President Trump's tariff announcement. Remember, he's planning to announce those reciprocal tariffs before a meeting with the Indian Prime Minister, Modi.
Right.
Well, the source mentions that Deere, that farm equipment company we talked about, is already expecting another rough year, and they're specifically blaming the steel and aluminum tariffs for part of that.
Ah, so those tariffs are already having a real-world impact.
Exactly. Deere needs steel and aluminum to make their equipment. If those materials get more expensive, their costs go up, and they either have to eat those costs or raise prices, which could hurt their sales.
It's like a chain reaction.
Right. It shows how these tariffs aren't just abstract policy debates. They have real consequences for companies and the people who work for them. And speaking of companies feeling the heat, the source also mentioned Constellation Brands.
The beer folks.
Yep. Turns out they could be affected by potential tariffs on imported oil.
Oil. I thought we were talking about beer.
Well, oil is a key ingredient for a lot of things, including packaging and transportation. So even companies that don't directly use oil in their products can be affected by rising oil prices.
Oh, I see. So those tariffs could indirectly impact Constellation Brands even if they don't tax the beer itself.
Exactly. And like we discussed earlier, if they don't raise beer prices to cover those extra costs, their profits could take a hit.
It's a tough situation trying to balance all these forces. It really highlights how interconnected the global economy is.
It's all connected, for better or worse. Speaking of interconnectedness, your source also pointed out some interesting things happening in the stock market.
The market's always a good indicator of what people are thinking and feeling. What caught your eye?
Well, Reddit was one that popped up. I actually didn't realize they were a publicly traded company.
Yeah, they are, though they're not exactly having a party right now. The source mentioned their stock dropped after they missed user growth targets.
Missed user growth targets. That's not a good sign for a social media company. What happened?
They're blaming it on changes to Google's search algorithm. It's apparently making it harder for people to find Reddit content organically.
Ah, the power of algorithms. They can make or break a company these days.
Absolutely. But the source also mentioned that even with those user growth struggles, Reddit is seeing some positive signs, especially internationally.
Oh, interesting. So there's still potential for growth.
Definitely. And speaking of growth, there were some interesting developments in the AI space, specifically in China.
China's always pushing the boundaries when it comes to tech. What's going on over there?
Well, there's news about a partnership between Apple and Alibaba. They're teaming up to bring AI services to the Chinese market.
Apple and Alibaba. That's a pretty big deal, isn't it?
It is. Apple's a global powerhouse, and Alibaba dominates in China.
That's a lot of combined power. And the source specifically mentioned that Apple chose Alibaba over another potential partner, a startup called Deep Sea. Why Deep Sea?
DeepSea just didn't have the experience or the manpower to handle a collaboration of that size. It shows that in the world of AI, scale matters.
Makes sense. And with those two giants teaming up, it'll be interesting to see how that partnership plays out, especially given all the geopolitical tension.
Absolutely. It's not just about tech, it's about global power dynamics.
Exactly. And speaking of partnerships, the source also mentioned the IPO of SailPoint, a cybersecurity company.
Cybersecurity, that's a hot sector these days, with all the data breaches and hacking going on.
Right. It seems like every day there's news of another attack. So it's not surprising that investors are eager to get in on the cybersecurity action. The source said SailPoint raised over $1 billion in their IPO.
That's a strong vote of confidence from the market. It shows that investors see a lot of growth potential in that sector.
Makes sense. Now, switching gears a bit, let's talk about the U.S. economy in general. Your source highlighted some interesting data points.
Always good to check the economic pulse. What's standing out?
Well, one good sign is that initial jobless claims fell last week, so the labor market seems to be holding steady.
That's good news. A strong labor market is crucial for economic growth.
But wait, the source also said that even with that good jobs data, Americans aren't feeling too optimistic about the job market.
It's a weird disconnect, right? Jobs are stable, but people still feel uneasy. The source suggested it might be due to slower hiring overall and all that economic uncertainty we've been talking about. You know, those potential tariffs and spending cuts. So it's more of a psychological thing.
It seems that way. Even if things aren't terrible right now, the fear of what might happen can really weigh on people.
Definitely. And that fear can affect how much people spend, which impacts the whole economy. Speaking of anxieties, the source also mentioned decline in consumer confidence and inflation data that's coming in hotter than expected.
Ooh, not good.
Not ideal. And it all feeds into that potential stagflation scenario we discussed earlier.
Right, inflation going up, economy slowing down, not a good recipe. The source also pointed to a few specific companies that are struggling right now. Deere is one. They're not having fun with those tariffs.
Right, the farm equipment folks.
Yeah.
Things could get even tougher for them if those tariffs expand to other countries, like Trump has hinted at.
Exactly. Their fate is tied to global trade, and things aren't looking too bright on that front. The source also highlighted Robinhood, the trading app. Remember how popular they got during the pandemic?
Yeah, they were everywhere.
Well, it turns out keeping those users is getting expensive. They're having to offer a lot of perks, like matching contributions for IRAs and higher interest rates on savings accounts.
Those incentives add up quickly.
They do, and the source quoted an analyst who's worried about Robinhood's long-term profits if they have to keep spending so much just to keep people using their app.
It's a tough situation for growth companies. They need to spend to grow, but that can hurt their bottom line.
A real balancing act. Now, on a more positive note, the source also mentioned a few companies that are actually doing quite well, defying the odds. Crocs, for example.
Crocs. The colorful clogs. I thought those were so last decade.
Apparently not. Their stock is doing great. The source said they're benefiting from strong demand for their Hey Dude brand.
Hey, dude.
It's a brand they bought recently. Casual, comfortable shoes, perfect for the work-from-home world we live in.
Makes sense. Comfort is king these days.
Right. And the source also mentioned Crocs' strong online presence and their focus on international expansion. Those are helping them grow, too.
Smart moves. It shows that even in a mature industry like footwear, there's still room for innovation and growth.
Absolutely. Another company that's doing well, according to the source, is Yeti.
Yeti. The expensive coolers and tumblers.
The very same. Their stock's on the rise, too, even with all the market volatility.
What's their secret?
They've built a reputation for quality and durability. People are willing to pay a premium for products they know will last.
So is it a brand thing?
Definitely. And they're also good at innovating and expanding their product line, which helps them stay ahead of the competition.
Makes sense. Always got to keep things fresh.
Right. The source also highlighted Intuit, the company behind TurboTax and QuickBooks. They're benefiting from the shift to online financial management.
Ah, Intuit. A tax season staple for many.
Yep. And their online services are getting more and more popular. The source specifically mentioned their TurboTax Live offering, where you can connect with a tax expert online. Pretty clever adaptation to this virtual world we live in.
It is. As our lives move online, so do our finances. Companies like Intuit are smart to capitalize on that trend. And the source mentioned they're also using AI and machine learning to improve their products, which is pretty cool.
AI is everywhere these days. It's changing everything.
Absolutely. And speaking of AI, the source also dropped some interesting news about President Trump's tariff plans.
Ugh, those tariffs again? What's the latest?
Well, it seems Trump's considering putting tariffs on copper imports.
Copper. I thought we were talking about steel and aluminum.
Apparently, there are concerns about China's dominance in the copper market. The source quoted a trade advisor who said it's all about national security.
Oh, I see. So it's another battlefront in that U.S.-China trade war. It's like every commodity is becoming a weapon.
It's a complicated situation with far-reaching consequences. And speaking of those consequences, the source also mentioned another potential impact: higher auto insurance premiums.
Wait, auto insurance, we talked about beer prices, but how do tariffs tie into car insurance?
It's all about the car parts. If they slap tariffs on imported car parts, the cost of repairs goes up. And guess who ends up paying for that?
The consumer, of course. It's always the consumer who gets squeezed.
Sadly, that's often the case. And the source also mentioned that usage-based insurance is getting more popular. Depending on how you drive, that could either help or hurt you.
Usage-based insurance. That's where they track your driving and adjust your premiums based on how safe you are, right?
Yep. It's becoming more common as the technology gets better. If you're a good driver, you could save money. But if you have a lead foot, you might end up paying more.
It's like a trade-off between privacy and potential savings.
Exactly. Now, remember that whole discussion about the FDIC and those proposed bank regulation changes? Still feeling a little nervous about those?
Definitely. And the source highlighted some specific ways those changes could hurt consumers, things that could hit our wallets directly.
Okay, I'm bracing myself. What's the bad news?
Well, first up, higher bank fees. If the FDIC's role is weakened, banks might feel like they can get away with charging more for things like checking accounts or overdraft protection.
Ugh, that's the last thing I need. Bank fees are already ridiculous.
Tell me about it. And unfortunately, it doesn't stop there. The source also mentioned the possibility of higher transaction costs.
Transaction costs? You mean like fees for using ATMs or transferring money?
Exactly. If they loosen the regulations, banks could take advantage and raise those fees.
It feels like we're getting squeezed from all sides.
I know, right? And there's one more potential consequence that's even more worrying: the possibility of predatory lending making a comeback.
Predatory lending. That sounds scary. What does that even mean?
It's when lenders target people who are already struggling financially, maybe with bad credit or limited financial knowledge, and offer them loans with sky-high interest rates and fees. It was a huge problem leading up to the 2008 crisis.
So we're talking about loans that are designed to trap people in debt. That's messed up.
It is, and a lot of experts are worried that deregulation could create the perfect conditions for these predatory practices to flourish again.
It's a sobering thought. I guess the takeaway here is that we need to be extra careful and informed, especially about our money.
Absolutely. Knowledge is power, especially when it comes to finances. The more you understand about how these changes could affect you, the better you can protect yourself.
Well said. And speaking of things we need to protect ourselves from, the source also highlighted the potential impact of deregulation on the housing market.
The housing market. How does that fit in?
Well, remember the Consumer Financial Protection Bureau, the CFPB?
Yeah, the agency that's supposed to protect us from those abusive lending practices.
Right. Well, the Trump administration is considering making changes to that agency, too. And the source suggested that those changes could make it harder for the CFPB to enforce regulations, which could leave consumers more vulnerable to predatory lending in the housing market.
That's not good news for anyone looking to buy a house. And the source mentioned that the housing market's already facing some challenges, even without all this deregulation talk.
Right. Like what?
Well, rising mortgage rates are a big one.
That makes sense. The Fed's been raising interest rates to try to control inflation, and that affects mortgage rates, too.
Exactly. And the source quoted a real estate expert who said those high mortgage rates are a big reason why home sales are slowing down.
It's simple supply and demand. When it costs more to borrow money to buy a house, fewer people can afford to do it.
Right. And on top of those rising mortgage rates, there's still a huge shortage of affordable housing.
That's a problem that never seems to go away.
It's a tough one. The source mentioned things like zoning regulations, construction costs, and of course, wages not keeping up with the rising cost of living.
It's a vicious cycle. Wages stagnate, housing costs rise, people can't afford to live anywhere,
Yeah.
and the shortage gets worse.
Exactly. It's a mess. But the source did highlight some potential solutions to this affordable housing crisis.
Okay, I'm all ears. What can be done?
One idea is to increase the supply of affordable housing units. This could mean relaxing zoning regulations to make it easier to build more homes, giving tax breaks to developers who build affordable units, and investing more in public housing projects.
Those sound like good ideas in theory, but I imagine there are a lot of obstacles in the real world.
There always are, especially when it comes to politics and money. But the source stressed the importance of exploring these solutions and pushing for policies that make affordable housing a priority.
It's a basic human right, not a privilege. Everyone deserves a safe and affordable place to live.
Couldn't agree more. And the source also mentioned another potential solution, increasing wages.
Getting to the root of the problem. Even if we build more affordable housing, it won't help much if people can't afford it.
Exactly. The source advocated for policies that support wage growth, like raising the minimum wage, giving workers more bargaining power, and investing in education and job training programs.
It's about creating a system where everyone has a chance to earn a living wage and afford a decent place to live.
Absolutely. And on a slightly lighter note, your source mentioned that the beer industry might be feeling the squeeze from those tariffs, too.
Oh no, not beer. What's happening there?
Apparently, Constellation Brands, the folks who make Corona and Modelo, could be hit pretty hard by potential tariffs on imported aluminum.
Aluminum. For the beer cans.
You got it. If those tariffs happen, it could raise Constellation Brands' production costs, which could lead to higher beer prices.
Ugh, nobody wants to pay more for their beer. It's amazing how these tariffs can have such a ripple effect, impacting everything from farm equipment to beer.
It's all connected, I'm telling you. And speaking of unexpected impacts, the source also mentioned that Tesla, the electric car maker, could be affected by tariffs as well.
Tesla? How so? They're an American company, right?
They are, but they use a lot of imported parts for their cars. If tariffs are placed on those imports, it could make their cars more expensive to produce, potentially leading to price hikes.
That's not good news for anyone who's been saving up for a Tesla.
Right. And it could make them less competitive against all those other electric car companies that are popping up everywhere.
Competition in the EV market is fierce.
It is. And speaking of the tech world, the source also mentioned a legal battle brewing between Elon Musk and OpenAI, the artificial intelligence company he co-founded.
Wait, Musk is fighting his own creation? That's interesting. What's going on there?
Well, it seems Musk isn't happy with the direction OpenAI's been taking. He's actually trying to buy the company back for a whopping $97.4 billion.
Wow, that's a lot of money. Why is he so determined to regain control?
It seems he's worried about OpenAI shifting towards a for-profit model. He thinks it goes against their original mission of developing ethical AI.
So it's a battle over the future of AI and how it should be developed and used.
Exactly. And the legal fight is focused on whether OpenAI's leadership violated their duties by going for-profit without asking the board's permission.
It's a fascinating case with big implications for the whole AI industry. It raises questions about who gets to control this powerful technology and what ethical considerations should guide those decisions.
It's a good reminder that technology isn't neutral. It reflects the values and choices of the people who create it, and we need to be careful about the potential consequences of our technological creations.
Absolutely. And speaking of impactful technologies, your source also highlighted the increasing use of AI in the cybersecurity world.
Oh yeah, AI is proving to be a valuable tool in the fight against cybercrime. It can analyze huge amounts of data to spot patterns and anomalies that could indicate an attack.
Makes sense. AI is great at finding patterns that humans might miss.
Exactly. And the source also mentioned that AI is being used to create more sophisticated cybersecurity tools, like those that detect intrusions and analyze malware.
It's an arms race. Hackers are constantly finding new ways to attack, and AI is becoming a crucial weapon in defending ourselves.
Absolutely. And speaking of trends shaping the financial world, your source also talked about the rise of ESG investing.
ESG investing. I've heard the term, but I always forget what it stands for.
ESG stands for environmental, social, and governance. It's an investment approach that looks beyond just financial performance.
So investors who follow this approach are looking for companies that are doing good in the world, right?
Exactly. They want to invest in companies that are committed to sustainability, social responsibility, and good corporate governance.
So it's about aligning your investments with your values.
Exactly. And the source mentioned that ESG investing is becoming more and more popular. It's not just a niche thing anymore. Investors are realizing that their money can make a difference.
It's a powerful idea. Using your investments to support companies that are making a positive impact.
Absolutely. Now let's talk about another trend that's reshaping the labor market: the rise of the gig economy.
The gig economy, the world of freelancers and independent contractors. It's been growing for years now.
It has, and it's a mixed bag. On the one hand, it offers flexibility and independence, but on the other hand, gig workers often lack benefits and job security.
Right, it's a trade-off. And the source mentioned that policymakers are struggling with how to regulate this growing part of the workforce.
It's a tough one. How do you protect workers' rights when the traditional employer-employee relationship is changing?
It's a question we're still trying to answer. Now, let's go back to those tariffs for a minute. Your source also highlighted how they're affecting the agricultural industry.
Agriculture is such a crucial part of the U.S. economy. How are farmers being affected by these tariffs?
Not well, unfortunately. The source said that tariffs on agricultural exports are making it harder for U.S. farmers to compete globally. Their products were becoming more expensive for buyers in other countries. It's tough for farmers who are already dealing with thin margins and unpredictable weather.
Absolutely. And it's another example of how interconnected the global economy is. Decisions made in one country can have a ripple effect on farmers and consumers around the world.
It's true. And speaking of global challenges, the source also highlighted another threat to agriculture: climate change.
Climate change is a threat to everyone and everything.
It's the ultimate disruptor. How is it specifically impacting farmers, though?
Well, the source mentioned that climate change is causing more extreme weather events like droughts, floods, and heat waves.
And those extreme events can be devastating for crops and livestock.
Exactly. They can damage crops, reduce yields, and make it really hard for farmers to plan for the future.
Agriculture relies on predictable weather patterns. Climate change is throwing those patterns out of whack.
It is. And the source also pointed out that climate change is contributing to the spread of pests and diseases that can harm crops, which adds another layer of difficulty for farmers.
It's a multifaceted problem, and there's no easy fix.
Definitely. The source emphasized the importance of investing in drought-resistant crops, developing more sustainable farming practices, and reducing greenhouse gas emissions.
Those are all crucial steps, but they require a collective effort from governments, businesses, and individuals around the world.
It's a reminder that climate change is a problem we all share, and we need to work together to solve it.
Absolutely. Now let's switch gears a bit and talk about a trend that's shaking up the food industry: the rise of plant-based foods.
It's amazing how mainstream plant-based foods have become. I remember when veggie burgers were like a novelty item. Now there are so many options, from plant-based meats to dairy alternatives to even seafood made from plants.
The technology has come a long way. Some of these products are so realistic, it's hard to tell the difference from the real thing.
I know, right? I recently had a plant-based burger that tasted just like a beef burger.
It's incredible what they can do with plants these days.
It really is. And your source pointed out that this trend is being driven by several factors, including concerns about the environmental impact of meat production, growing awareness of the health benefits of plant-based diets, and of course the fact that these products are just plain delicious.
The combination of things coming together at the right time, and it's creating a huge market opportunity.
Absolutely. And it's not just individual consumers who are embracing plant-based foods. Big food companies are getting in on the action too. They're investing heavily in plant-based alternatives.
They see the writing on the wall. Consumer demand is changing, and they need to adapt to stay relevant.
It's a great example of how market forces can drive positive change.
And it's not just plant-based foods that are changing the way we eat. The source also mentioned the growing popularity of meal kit delivery services.
Those companies that send you pre-portioned ingredients and recipes to cook at home, they've definitely taken off in recent years.
They're so convenient. It's like having a personal chef without the price tag.
Exactly. And the source pointed out that this trend is driven by several things: convenience, affordability, and the desire for healthier meal options.
It's a winning combination.
It is, and it's not just individual consumers who are using meal kits. Companies are partnering with grocery stores and restaurants to expand their reach.
It's a sign of a growing and evolving market.
Absolutely. Now, let's talk about another industry that's being affected by those tariffs. Retail.
Retail is such a broad category.
Yeah.
How are those tariffs playing out in such a diverse sector?
Well, the source said that tariffs on imported goods are pushing up costs for retailers. And those higher costs are likely to be passed on to consumers in the form of higher prices.
Ugh, not what we need with inflation, already a concern.
I know, right? It's a tough spot for retailers. They need to absorb some of those costs to stay competitive, but they also need to protect their profits.
It's a balancing act for sure. And the source quoted a retail expert who said these tariffs are creating a lot of uncertainty in the market, which makes it hard for businesses to plan for the future.
Uncertainty is never good for business.
Definitely not. And on top of all that, retailers are also dealing with the rise of e-commerce.
Ah, the ongoing battle between online giants and brick-and-mortar stores.
It's a trend that's been going on for years, and the pandemic only accelerated it.
It did. And with more and more people shopping online, traditional retailers are scrambling to adapt.
They're closing stores, investing in their websites, and trying new things like curbside pickup and same-day delivery.
It's a fight for survival.
Absolutely.
Yeah.
The retailers that can successfully adapt to the new reality of online shopping will be the ones that thrive.
It's a great example of how innovation is crucial in today's world. Companies that cling to outdated models are going to get left behind.
True. And your source also highlighted another important trend in retail, the growing importance of sustainability.
Sustainability is no longer a niche concern. It's becoming a mainstream expectation.
Exactly. Consumers care about the environmental and social impact of their purchases. They want to support companies that are doing the right thing.
And they're willing to put their money where their values are. They're choosing brands that align with their beliefs about sustainability.
It's a positive trend. Consumers have a lot of power, and they're using it to drive change.
Absolutely. The source mentioned that retailers are responding to this demand by adopting more sustainable practices, things like reducing waste, using recycled materials, and sourcing products from ethical suppliers.
It's a win-win situation. Consumers get the products they want while supporting companies that are trying to do better, and retailers enhance their brand reputation.
It's a good reminder that businesses can be profitable and ethical.
Absolutely. Now let's talk about another industry that's feeling the heat from those tariffs. Technology.
The tech industry is so global and interconnected. How are tariffs impacting this crucial sector?
Well, for a lot of tech companies, it's a double whammy. They're facing higher costs because of tariffs on imported components, and they're also dealing with intense competition from Chinese tech companies.
Right, the Chinese tech industry is a force to be reckoned with.
It is. And it's a reminder that the tech landscape is constantly changing. Companies need to be adaptable and innovative to survive.
So we were talking about the tech industry and all the challenges they're facing.
Right, those tariffs are really putting a squeeze on a lot of tech companies, especially with those rising costs for imported parts.
And you can't forget about that fierce competition from Chinese tech companies, too.
Yeah, they're really coming on strong, constantly innovating and pushing boundaries.
It's a reminder that in tech, you can't just sit still. You have to constantly adapt and evolve, or you'll get left behind.
Exactly. And speaking of constant threats, we can't overlook the whole cybersecurity landscape. The source material really highlighted how cyber attacks are becoming more frequent and more sophisticated.
It does feel like every day there's news about another hack or data breach. Kind of makes you paranoid about going online.
Well, there's a reason for that paranoia. Hackers are constantly finding new ways to exploit weaknesses, and it's a full-time job for cybersecurity professionals to stay ahead of them.
It's like an arms race.
It is.
Mm.
And it's not just up to companies and governments to protect us. We all have a role to play.
Right, like what can we do as individuals to protect ourselves?
A lot, actually. Using strong passwords, being careful about what links you click, keeping your software updated, those simple things can make a big difference.
Good advice. Now, let's shift gears a bit and talk about a topic that's been dominating headlines lately, the possibility of a recession.
The R word. Everyone's talking about it, but no one seems to know for sure if it's actually going to happen.
Right. So what are the experts saying? Is a recession inevitable?
Well, the source material presented a range of opinions. Some economists think a recession is unavoidable. They're pointing to things like rising interest rates, inflation, and slowing economic growth.
That's a lot of headwinds.
It is, but other economists are more optimistic. They argue that the economy is still fundamentally strong, with low unemployment and decent consumer spending.
So no clear consensus then.
Not really. It's like trying to predict the weather. There are so many variables, it's hard to say for sure what's going to happen.
So what's the best course of action? Just wait and see.
Well, regardless of whether a recession hits or not, it's always a good idea to be prepared.
Okay, that makes sense. So how do we recession-proof ourselves?
The source had some good advice on that. Building up an emergency fund is crucial. Having a financial cushion can really help if you lose your job or face unexpected expenses.
Solid advice, recession or no recession.
Right. And paying down any high-interest debt you have is another smart move, especially with interest rates going up.
Less debt, less stress.
Exactly. And of course, diversifying your investments is always a good idea. Don't put all your eggs in one basket.
Spread the risk, right.
Exactly. Now let's talk about another sector that's facing some serious challenges. The energy industry.
Energy is so vital to everything, and with oil prices being so volatile lately, it's definitely a sector to keep an eye on.
Absolutely. And those tariffs aren't helping either. The source material highlighted the fact that tariffs on imported solar panels are driving up costs for solar energy companies.
So that's slowing down the shift to renewable energy, right?
It is, which is a setback for efforts to fight climate change.
It's a shame. We need to be moving towards cleaner energy sources, not making them more expensive.
I agree. And on top of the tariff issues, there's all that volatility in oil prices.
Yeah, filling up my car has become an adventure. One week it's sky high, the next week it's down a bit, then up again. It's hard to keep track.
It's hard to plan, too, especially for businesses that rely heavily on energy.
So what can be done about this energy mess?
The source highlighted a few key strategies. Investing in renewable energy is crucial for both the environment and our energy independence.
Right, we can't keep relying on fossil fuels forever.
Exactly. We need to make that shift to cleaner energy sources. And improving energy efficiency is another important step. If we use less energy, we're less affected by those price swings.
Makes sense. Less waste is always a good thing.
Absolutely. And diversifying our energy sources is important too. We need a mix of renewables, nuclear, and maybe even some cleaner fossil fuels in the short term. That way we're not so reliant on any one source.
So a balanced approach. Got it.
Exactly. But it's going to take a collective effort to make this happen. Governments, businesses, and individuals all need to work together to create a more sustainable energy future.
We're all in this together, right?
We are. And that's a good reminder as we wrap up this deep dive. We've covered a lot of ground, from economic anxieties to the power of AI to the challenges facing different industries.
It's been a whirlwind.
It has. But hopefully you're walking away feeling more informed and empowered to navigate this complex world.
I know I am. And if there's one key takeaway from all of this, it's that knowledge is power.
Couldn't agree more. By staying informed, questioning assumptions, and thinking critically, you can make better decisions, feel more in control, and build a more secure future.
That's what the deep dive is all about. We're here to help you make sense of it all, connect the dots, and empower you to take action.
So keep exploring, keep learning, and keep diving deep.
Thanks for joining us.